We wanted to start off this morning with a conversation about many of the same topics that we've been talking about at this conference, but through a different lens. So I'm really excited to have with me Julien Dumoulin-Smith, who's the Executive Director of, I think, Utilities at UBS Investment Research. So in this conversation, we're talking about solar, but from the context of the public markets, both as it pertains to solar companies and as it pertains to utilities and anyone else who's being traded in the public markets. And we want to sort of address what's going on right now, but also what do we think is coming next. So Julien, welcome.
Thank you.
And before we get into it, just a reminder, same as yesterday, if you want to ask questions, I've got the iPad in front of me, so go to gtm.cnf.io, log into this session, ask your questions, upvote other sessions or other questions, and we'll get to as many of them as we can. So Julien, let's start with this. What the hell is going on with solar stocks, right? Like every solar stock is down a lot this year. And there are a bunch of different kinds of companies. There's the distributed solar installers, there's the big sort of vertically integrated suppliers, there are the technology companies like Enphase and all those guys. Everybody's down universally. How much of that is investor sentiment having turned against solar, and how much of it is sort of company-specific issues?
So first off, good morning, everyone. Again, as Shayle said, Julien Dumoulin-Smith, UBS. And so by way of background, I cover the publicly traded power, utility, and renewable companies, right? So we cover across the spectrum. And so the answer is, when you look at the solar stocks of the last year, whether it's SunEdison or SunPower or First Solar or Solar City, yada, yada, I mean, the reality is it's obviously not the oil factor, right? We kind of know in the US, like, wait, does it really matter? No. The answer is, it's really discrete subjects pertaining to each one of these companies, right? When you break it down, right? And you can start with, for instance, SunEdison, right? You ask yourself, like, what happened there, right? And I actually think that what happened there at its core is probably no different than many other companies that have actually seen their demise, right? It's leverage. It's called taking out a lot of debt against a startup company, right? I think that's really the core that you got to think about when you think about why was that stock so volatile? Why did it fall so fast? I think the answer is, when you see companies that employ that much leverage in their capital structures, you see a lot of volatility. You're bringing it on, right? By employing that amount of debt, you are saying, we are risky. We do want to go for the gold, right? And so I think the consequence of that is having a lot of volatility in the stock. But that's separate and discrete from what's going on in the First Solar, the First Solar, SunPower, and the manufacturing side of the equation, where I think, frankly, probably a lot of you are well aware of the deflationary pressures taking place and the declines in the cost curve, and what that means for the ability for a lot of these companies to just maintain pricing, right? Gross margins are under pressure across the across the industry, and as you see, the manufacturers obviously have the pressure. So I think that one's probably at its core the clearest, right? I'd encourage you all to recognize that that's a pricing issue right there. And then when you turn back to the residential side of the sector, where you're like, okay, so I've explained the manufacturing side, I've explained the development side, and again, I think it's more coincidental than anything else, right? The reality is, on the residential side, you've got a few different factors. One, there's competition, right? There's something to be said about pricing. But two, I would encourage you all to think about, again, you're employing leverage. Why is Solar City so volatile? It's amongst the most levered renewable companies we've ever seen, right? Again, it's not a surprise. It's a direct outcome of the corporate strategy, right? But I'd take it a step further, and I'd think about the backdrop for residential solar more broadly. Again, are they competitive in the marketplace in their pricing? Are they suffering in terms of their ability to deploy? Clearly, right? And that's why the stocks are down. They're levered operationally, and they're just high fixed cost structures, and on top of that have high leverage. So again, if you break it down and look at it, each one of them has a different story they're telling. And then maybe even lastly, right, and bring it back, where we started with SunEdison, let's bring it back to Terraform and these yieldcos. What's happened there, right? A totally separate conversation about pressures bringing that sector down. And I think there too, people talk about financial engineering, et cetera, but I think the reality is this is actually probably the closest thing to investor confidence there is that has suffered in the last 6 to 12 months. And I think the reality is, you're going to naturally see the yieldco sector morph into what is an organically developed in-house grown renewable business, right? That is the first example of a publicly traded renewable company that's going to have a base of assets, and over time they're going to start growing themselves. I think look at Pattern Energy or look at NRG Energy as examples of companies that over time are going to be bringing in-house their own development efforts, and that makes some amount of sense. So I'll leave it there, and I'll let you get another question.
All right. So, you're saying, first of all, there's no sort of underlying single thing driving all of this. You look at every company or sort of set of companies that are all down this year and can explain them individually.
I mean, it would be convenient to think that oil was doing this, or that rates were doing it. But I think that's really not the case. You can't really blame that. I mean, technically speaking, I think the rally we've seen of late in the sector, right, call it, and it's a little bit of a blip in the backdrop, might be in some part due to oil, might be in some part due to sentiment on the election. But I don't necessarily think you can really claim that any sizable underperformance we've seen in the last year is due to some macro, like, industry-wide factor.
Right. So I want to just take a minute to kind of walk through the leverage thing that you've mentioned, because I don't know, I think it's an interesting question to try to learn a lesson from for solar companies and renewable energy companies in the future. So, these companies, let's look at just SunEdison, right? SunEdison was raising all this debt, spent a couple of years doing so. Meanwhile, from a public market standpoint, was doing fine. And then something turned, right? And people sort of point to the announcement of the Vivint acquisition as having been that point in time. But regardless of what did it, something turned, and then it all came crashing down pretty quickly. So the question is like, yeah, they were highly leveraged, but wasn't that okay for a while, and what changed?
Yeah, I think the cautionary story with SunEdison that at least, again, coming from a utility world principally, again, by way of background, and entering the renewable space, the renewable companies tend to use these things that are called convertible bonds and treat them largely as, oh, this is a share issuance. But again, let's focus on that last piece. It's a bond that you owe people back money on. And I think initially, when these things are quote unquote in the money, there's a lot of perception that, hey, listen, this is just another way to raise capital in an efficient manner. But the reality is those obligations are really what drove SunEdison to be highly levered in the down cycle. So I think converts, as the parlance might go, is a highly attractive source of capital for quote unquote growth companies. I think in this instance, you got to recognize that SunEdison at the end of the day was basically an infrastructure developer, and you need to do that with equity, right? Like for instance, one of the cautious elements of the story is residential solar is an incredibly capital intensive business. Yet there is a real caution still today that these companies don't believe that they should be going and raising external capital, that they should just principally just be using leverage as a way to finance that business. And frankly, I think as an outsider looking in, coming from all these other infrastructure businesses, that today the renewable and solar industry remains the anomaly here. They're so implicitly aggressive in their use of leverage. I mean, SunEdison is an outcome of this in some respects, but the perception issues remain, right? And again, I think it's because you're taking what has historically been a growth industry and trying to shove huge capital-intensive businesses behind them, right? I mean, it's one thing to develop a technology, and it's another thing to deploy it at $3,000 a watt.
So there's a question from the audience that relates to, I think, exactly what you were just talking about, which is, what is your take on the cash equity market in residential solar? Do you think that's an efficient mechanism to finance it? Before you answer, maybe describe what the cash equity market is and how that's been employed thus far.
Right. Yeah, I think the cash equity piece is a fine way to go, right? I mean, the question might be, well, how am I raising this capital, right? And so cash equity in this instance, and again, you can come up with a lot of different iterations of this, but I would imagine what's being argued is basically let's largely sell these assets to customers, right? Whether you sell it outright or you provide them a loan to be able to do this, that is much more of an outsourced model in which you're not necessarily needing to put up the capital. It's very convenient in today's market in which the stocks, the capital markets around solar are under pressure, such that it kind of makes sense. Like, listen, let's save our precious cash flow balance sheet, and basically be more of a flow business at this point. And I think you'll see this through a variety of different implementation mechanisms, but I think that's the bias today. Again, I don't necessarily think down the line it needs to go this way, right? You can still engage in leasing, or frankly, be the loan provider. You're effectively the lender of that money to the customer. It doesn't necessarily need to mean that you can only sell it to them and they're going to go outsource and find their own financing independently. It doesn't need to be that way. But that certainly is the way that you conserve cash in today's market.
There's another question here that I like. Is solar going to be like the airline sector, where despite high growth, nobody's making any money? Another way to ask that question, do you see a future in which there is a group of profitable, GAAP profitable solar companies that are big and successful and international, sort of like SunEdison wanted to ultimately be, but ones that actually earn profit, or do you see this as a profitless enterprise?
I mean, I think I have two immediate reactions to that. The first one is, to what extent has SolarCity and the residential solar sector been effective at actually garnering a wide margin in what they're selling consumers versus their cost, right? Think about it this way. I mean, you're selling a product door to door largely, or approaching someone in a setting in which they don't know what they should be paying, right? You're tying solar costs to the cost of electricity, which frankly are fairly independent variables today, right? So in theory, there should be a wide margin to exploit there, right? The ability for customers to go and shop, on a trailing basis was much less so than on a forward basis. So actually, in theory, the best days of profitability are exactly in that nexus that we've been seeing over the last years. It's sort of, in some senses, you lose sight of that, given everything else going on around SolarCity. But those are the best days, frankly, right? Net energy metering, 100% compensation, give me that. Those should be the cream of the crop kind of days. Now, rolling forward and thinking about, well, the bulk of this industry seems still to be the utility scale industry. Let's be honest with ourselves. What is the right return, right? When you talk about, will this business be profitable? I mean, I think the insurance companies and largely the infrastructure investors in this asset class are looking for a low risk, medium to low return profile, right? That is what it is. It's not. You should not expect this to be a high return business, right? That's what we've seen. In fact, reality, think about this. I mean, you could actually argue that this sector is going to be more competitive than the airlines in some respects, because what are the barriers to entry to true utility scale development, right? It's can I buy a panel better than the next guy? Can I buy my equipment better than the next guy? Can I find siting better than the next guy? I mean, siting, given the limited discrepancies in a given geography on solar incidence rates, is all about getting the interconnection queue and getting a better place in transmission. In basically the transmission geography of that region, right? So the reality is those barriers to entry are lower for developers, and ultimately the variability in the dispatch of these assets is lower than even wind. So when I think about it, 20-year cash flows, locked, with limited uncertainty on what the volumes are, coupled with limited development barriers to entry, I mean, it should be a low return business in some respects. That's not necessarily a bad thing, right? When you think about the ability to bring this back to consumers, right? It's been incredibly deflationary. Consumers win the bulk of it, and frankly, I think a lot of the investors aren't necessarily saying they're in it for a high return vehicle. There
are actually a bunch of really interesting questions from the audience.
Please, sorry,
here, so
I won't be.
No, I'm going to stick with these ones rather than my own because these are fun. Okay, well, there's a lot of them about residential. So what's your view on time of use implementation? I guess more broadly, let me ask, we were talking about this earlier this morning. You're looking at the NEM decisions coming in Arizona, places like that. You're presumably looking at time of use implementation in California. First of all, why are you paying attention to that stuff? How material is it to your coverage of the residential solar companies, and how material is it to your coverage of the utilities in those territories? And then what's your general outlook for the NEM battles that are occurring and also this sort of shift toward time of use rates?
Right. I mean, and let me sidestep time of use in some respects, because that is a subset of the core issues at play, right? I mean, I think realistically time of use makes sense. Yes, clearly over time, as you get AMI deployment across utility service territories, it makes sense to go in that direction, clearly. If you can implement tariffs that adopt that, yes, absolutely. But the bigger question is, what about net energy metering? And I think the reality is, and I'm going to put on it, I'll admit to it, I'll own it, appreciate it, that I'm a utility guy by way of background. I've entered the solar foray. And so therefore, when I deal with state PUCs, which we've been dealing with in a long time, you talk to them and the attitude is net energy metering is an unsustainable construct. It's a transitionary one. You're going to move towards avoided cost rates more broadly. The question is not if you move to ACR rates, it's how and what those rates are, right? Like, I think the conversation in Arizona is very different about avoided cost than it is in New York, right? Be very clear about that, right? One could be a premium versus NEM. One is going to be a big discount, right? The question is where it heads. And realistically, actually, I mean, and Shayle asked us for a specific reason. We pay more attention in Arizona for the likes of covering APS than we do Solar City or Sunrun. Realistically, what percent of their sales, and especially their profitable sales, are coming from Arizona, right? Those are the lowest margin sales they're making, and on top of that, it's probably less than 10% of their business and installs anyway, right? So realistically, how concerned are we for the resi players about Arizona and Nevada? Not very, right? If something changes in New York, that's a different story. If something changes in Maryland or Massachusetts, yeah, we're going to pay attention. If something changes in California, we're going to pay attention. But recognize that I think over time, this is sort of there's an opportunity set. The way that we value residential solar companies today is basically looking at NEM as a construct that over time sees greater pressure on the basically the value you can extract. And we look at this as kind of a 5 or 6 year NPV. The best years are right in front of you, and the question is, how quickly can you get your costs down to take advantage of 100% NEM across a variety of jurisdictions?
I think I want to go down the road a little bit on looking at utilities and sort of set solar aside for a moment, because you cover all these utilities, and you mentioned, I think it's interesting that you're paying attention to what's happening with the NEM dispute in Arizona because you're covering EPS more than because you're covering Solar City and Sunrun. But more generally, what is the current sort of outlook for utilities within the U.S. and to what extent is solar, and particularly distributed solar, like playing into that in a meaningful way versus the other underlying factors that utilities are facing, low load growth and so on?
Right. Let's break this down into 3 key areas, right? The first is, right, when you think about what's going on in the sector right now for utilities, right, why do we care about APS? Because resi sales are effectively lost load growth for this company, right? Arizona used to pride itself on demographic trends that would lend itself to meaningfully above peer trends in terms of sales growth. Now, the reality is, if you look at the details and the tariffs in Arizona, I mean, they basically have some quasi-decoupling mechanisms put in place that help to offset the impact of lost sales more broadly, right? So they can continue to earn their return. But I think the bigger question, right, is like, stop looking at the specific tariffs. What does resi solar mean for the utility sector? And I think at the end of the day, the reality is that at least I subscribe to would be that when you look at this construct through the next 5 to 10 year period, the reality is a lot of it means greater interconnection back to the grid. When I think about EV penetration, I think about California and their desire to green the grid in tandem with resi solar, right? That's the new policy priority. That to me means that the house is now consuming twice as much at their peak load consumption, right? So it's kind of like, all right, well, that means you're even more dependent. It's not necessarily the grid from a distribution network that we're concerned about. It's the sales and the actual need for the generation and electricity supplied from the grid that is much more critical. So I find it very interesting. In this audience particularly, we talk about what's the future of utilities, can utilities survive? And we completely skip over the conversation about, like, hold on, we have another sector called power. And they're the ones actually selling the generation to the end-use customers. They're the ones who are really getting whacked by this, right? That's where the real distress, you should be paying attention to the IPPs in the context of this big debate. Because realistically, if you haven't put this, if you haven't put it together, they're the ones who are shrieking. They're the ones who are very loud in DC and lining themselves up, against, any number of reforms and subsidies, right? I mean, that's the industry group you want to be paying attention to. The reality is, look at how Edison and SoCal Edison have reacted to the quote-unquote opportunity of distributed distribution investments of late, right? All of them are licking their lips. They're like, the utilities are like, hey, great, AMI, you want full deployment, 100% all customers, billion-dollar program, that's great. Let's do that for the next 3 years.
There's a question here that I'll broaden, but the question is, basically, assuming interest rates are going to be rising, what impact will that have? And the question is about on the residential solar industry, but I'd also ask the impact on utilities. So what, with the higher interest rates, what happens to the ability to offer residential loans and leases, and what do rising interest rates mean for utilities?
Yeah. I can't understate how important rates are, right? I mean, like, it's almost like the forgotten secret sauce in the entire sector, right? If solar is effectively a product where you pay everything up front, get all the benefits over 20 years, that to me is a DCF where the interest rate and or effectively the discount rate employed is critical. Much more than any other energy technology that we look at where there's meaningful ongoing costs, right? So why is it that buyers can afford to have a 6% levered discount rate when they look at acquiring solar assets? I mean, the reality is that the backdrop there is the interest rate environment. It's not just your cost of debt, it's your discount rate and the cost of equity embedded within that. And then separately, and much more importantly, when you think about the residential sector, well, at the end of the day, the utilities, their ROEs seem to go up and down, tied to the interest rate cycle. PPA prices will move up and down with the interest rate cycle. The reality is the resi sector is actually much more exposed, right? In some respects, the companies that are most exposed to the interest rate cycle are the resi solar players more than the utilities at the end of the day. They're operationally much more geared towards it than the other companies. Albeit at the end of the day, all boats rise and fall with this, right? Utilities will go up and down, and so will the entire solar industry should rates rise. And again, the question you got to ask yourself, and I'll throw this out to the group, is if rates rise on the front end of the curve, i.e. the Fed makes a move, does that necessarily need to have a meaningful impact on long-dated durations? And also appreciate what is a global low interest rate environment. And try to start piecing together, where are you seeing this capital come in, right? For instance, why are we seeing so many gas generation assets built in the US? And who's funding it? Have you looked at how disproportionately it comes from outside of the US? I mean, I think that A, as a funding mechanism and who you should be talking to fund projects, you should be looking in a broader context. And B, the empirical reality seems to be that as well.
That's an interesting point. So you're saying, the capital to deploy assets should be coming from outside the U.S. I mean, the limitation to that obviously is tax equity, right? Yeah. You don't have tax capacity if you're outside the U.S. But setting that aside, I don't think we have seen a lot of international capital going into solar assets yet. Why not?
I think you hit it, right? Like the tax equity piece is definitely relevant. I think it's difficult to track the source of capital though too, right? Like no one's ever going to come and hit you over the head like, here's where I got this money, here's what my LPs sponsor me from. But I think you got to appreciate at least the trends where you do see strategic corporates getting involved, where you do see a name brand attached to it. At least I'm noticing the trend. I think empirically you can say there's clearly a greater percentage of foreign ownership of late.
There's a question here about the impact of falling battery storage costs. Yep. How are you seeing that impacting investor sentiment about either solar or about utilities?
Yeah, I mean, again, let's interject this. It is really concerning for peak power. Peak power matters most for the IPP industry. It is really concerning, right? Statement of the obvious. When it comes back to the utility sector of the equation, right, the reality is, hey, listen, if this is another way in which we can invest in grid-scale T&D deferral, that should be our opportunity, right? If I were to leave you with one thing, you should recognize that as the industry becomes so-called reaches critical mass, it's no longer alternative energy, it's just energy. You're going to see utilities compete for this, right? So I think in terms of storage and the opportunity is, you should just be concerned across all fronts that the utilities are going to be out there and saying, no, PERPA, that's great, I know you like it, but we're going to strive as hard as we can to make sure that's something that we're doing either in rate base or with an affiliate or something like that. So I think the competitive pressures are perhaps most relevant there. But to hit your question also about tax equity, I think that's a real impediment.
Yeah, so that's interesting. So it's something we don't talk about a whole lot, but we talk about energy storage in the context of, one, pairing it with solar to alleviate the downside of NEM reforms or rate reforms or time of use rate arbitrage. We talk about utility scale grid storage as a solution to the duck curve and things like that, but you're making an important point, which is that really cheap utility scale storage is a replacement for a peaker.
Let's get this right, guys, just to set this, let's level set here. The reality is the first meaningful deployment of battery storage is almost entirely saturated, right? 2 years ago, we started talking about so-called frequency response in the PJM market, right? That had a 20% cash return on it. That return profile has come down meaningfully. I don't exactly know where pricing is right now. I will tell you, the developers who moved first, right, AES, RES, the big battery developers who've got the biggest deployments to date are all about frequency response. They were deploying it in 30-minute increments at $800 a kilowatt. That's been done now. And so the PJM market's saturated. The question is, when do you see other frequency response markets? It's like bang for the buck, right? The ancillary service opportunity is the greatest one before us. The question is, when do you design tariffs that allow you to take advantage of it? And then you move down the scale. I think you should expect grid scale storage to have a much bigger deployment prior to really getting to that resi opportunity. Maybe that's a statement of the obvious, but that's what we're focused on next, obviously out here in California. But frankly, pay attention to the omnibus energy bill that passed in Massachusetts this year, right? Storage is real in Mass as well, right? And that's where they're going to be the secondary opportunity is going to be.
Right. Short
duration batteries first, going to longer durations out over time.
Great. So there's a question about, I put up this chart yesterday morning that was just showing EIA's expectations for retail electricity prices this year for residential, and they expect it to go down slightly this year for the first time in recent history. And the question here is, what's driving that? You know, why are electricity prices declining this year for the first time of late, and would you expect that to sort of turn back as the EIA does?
Yeah, I mean, the question is, can you really expect utility rates to be structurally deflationary? Now, I think that's hard to argue. I mean, obviously, let's just talk about the backdrop of energy more broadly, right? Forget oil prices. Gas prices are what we care about domestically. Gas prices hitting a $2 handle still today across much of the Northeast. That is a really problematic price for a lot of people at the end of the day, right? You want to talk about walking away from NEM and walking to avoided cost rates? We'll have a conversation about what's the wholesale price of power at that point in time. I think down the line, though, you need to think about, especially for folks who are deploying solar and wind, one of the, if I were to throw something to challenge many of you in the room is, a lot of folks still make this assumption that, yeah, we'll just take some forward curves on power and we'll put that in for our terminal value. You should be thinking that your terminal value on these assets, not in terms of their ability to actually operate, but their ability to drive pricing power is going to be incredibly impeded 20 years out, right? Because if you have solar in California, your terminal value is going to be driven by what is the value of electricity at the peak of the day. So I know I took your retail energy argument and flipped it a little bit, but I think I see that across a lot of folks who are looking at power projects saying, oh yeah, there's real terminal value there, and I'm asking, that should be a deflationary number, not an inflationary one. In terms of wholesale prices.
Right.
Retail prices, obviously, given the trends for, say, AMI deployment amongst others, there is going to generally be a at inflation-like trajectory in terms of upward pressure. Not to mention what could happen if rates rise.
Right. We're short on time, but I'll ask you one last question that's from the audience here, which is one that we've talked about a couple of times here yesterday, and it's just a general question that I think is facing the residential solar industry, which is basically, will there be, 5 years from now, big, large national residential solar installers, or will there just be a long tail of many small residential solar installers? Where do you fall on that?
Admittedly, I don't see necessarily a strong proof that there needs to be a large number of, or there needs to be consolidated resi players. It's not unambiguous to me, right? The question is, let me repackage it a little bit. If that were to be the case, do you start unbundling what is a product today that is effectively, what is SolarCity and Sunrun first and foremost? Marketing businesses, right? They find customers. That's the bulk of the value, right? Second, and convince customers of the value proposition. Not that there needs to be much convincing in this world, but like that's the value, right? Installation, down the line, I think installation is a pretty commoditized business down the line. And then the financing element, you know what? You got to interject some cautionary element about the involvement in other financial institutions more broadly down the line. So it's the upfront marketing that really is the potency. Do you need a national brand to do that or not? Right? I mean, I think that's the critical question. So I don't think I have a clear answer on it. I think that's the way that I pose the question and ask myself. And I think there's merits to both sides of it. I think, frankly, you'll continue to see both.
Great. Well, that's all the time that we have. We're going to head straight into the crowdsource session next, so don't go anywhere. But in the meantime, please join me in thanking Julien.
Thank you, guys.